Hey there, and welcome back to the Deep Dive. Today, we are taking a serious plunge into something well, it's not just a buzzword anymore. It's really starting to reshape how global finance works. Asset tokenization.
That's right. It's moving fast. And to help us unpack it all, we've got a really fantastic source. It's a May 2025 report from the World Economic Forum put together with Accenture. The title is Asset Tokenization in Financial Markets, the Next Generation of Value Exchange.
And our mission today, pretty straightforward. We're going to, crack open this report, pull out the most important insights for you. Think of it like your shortcut to understanding what's coming.
Yeah, we'll cover what tokenization actually is, why it matters so much, where it's already happening, like real examples, and maybe most importantly, what's still holding it back.
And this isn't just, finance jargon for the sake of it. This is about how assets, things like stocks, bonds, maybe real estate, even carbon credits, could be owned and traded differently, more efficiently, maybe more accessibly.
Exactly. More transparently, too. We'll try to pull out those aha moments from the report, the surprising details that make you go, oh, okay, that's why this is a big deal.
So let's get into it. We'll start with the basics, the building blocks, then look at the big picture value, see where it's being used, tackle the roadblocks, and think about the ripple effects on the whole market structure.
Okay, sounds good. Let's start from the ground up. What is tokenization, according to this report?
So the core definition they give is using a programmable ledger, think DLT, blockchain, to represent asset ownership digitally. And crucially, it's in a transferable format.
Right. So the token itself isn't just data. It represents value, ownership, maybe even the history of the asset.
Exactly. And that programmable part is key, right? These ledgers can run smart contracts.
Code that just automatically does things when conditions are met. And the asset info could be right on the ledger that's on-chain, or the token could just point to an asset still sitting in a traditional off-chain system.
It helps to see the evolution they lay out. We had paper certificates way back when, pre-'80s.
Right, then electronic book entries from the 80s to the 2010s. More efficient, but still quite centralized usually.
And now, tokenization is this potential next step, using shared records, maybe more distributed, aiming for real-time transfers. But the report's smart to point out these big shifts take decades. This won't happen overnight.
That context is so important. So building on that, the report highlights two main ways this tokenization happens. First, backed tokens.
Backed tokens, like backed by a real-world asset.
Exactly. They represent an asset that already exists off-chain, like a digital claim check almost. You can, in theory, redeem the token for the underlying thing or its value. Think tokenized physical gold or shares held in your normal brokerage account but represented by a token.
Okay, so that's one model. What's the other?
Native tokens. These are born digital, issued directly onto the programmable ledger. There's no separate off-chain version. The report mentions things like sovereign digital bonds. The ledger is the definitive record from day one.
Got it. Backed versus native. And the report flags that the legal and operational stuff really matters here, doesn't it? Like, is on-chain ownership legally solid? How do you sync the chain with old records?
Absolutely. Huge questions. And operationally, for backed tokens, how do you prove the off-chain asset is really there? That often needs old-school audits. And getting the actual asset back if you redeem the token, that depends entirely on the issuer or custodian.
And they mentioned bankruptcy remoteness, too.
Yeah, critical point. Making sure that if the company managing the token goes bust, your underlying asset is safe and separate, legally protected.
Right. So to make these tokens actually work in finance, the report lists 6 key things that can be embedded in them. Attributes, they call them.
Like what the asset is, asset definition, what rights come with it, dividends, voting, embedded rights, where it's been provenance, who owns it now, ownership status, the rules around it, like who can hold it, compliance rules, and what they can do, permission controls.
And these are baked right into the token or the smart contract.
That's the idea. Putting the information and the logic, together on the shared ledger instead of scattered across different databases or needing manual checks.
Okay, it makes sense. And then for a trade to actually happen, you need the payment side, the settlement asset. They talk about DVP and DVD.
Yeah, delivery versus payment asset for cash, basically, happening at the same time.
And delivery versus delivery, maybe one tokenized asset for another.
And what are we using for that cash leg on chain?
Well, there's a whole range being explored. Fiat-backed stablecoins, you hear about those a lot. Then reserve-backed digital currencies, or RBDCs. Deposit tokens representing commercial bank money. Wholesale CBDCs from central banks. Even in some cases, crypto assets like Ether.
Wow, lots of
Yeah,
options.
and each has trade-offs. Liquidity, who you're relying on, counterparty risk, how fast it settles. It's complicated.
Okay, that covers the nuts and bolts. But, why bother with all this complexity? What's the actual value proposition? Why are people excited? Good question. The report boils it down to 5 core differentiators. Things that these programmable ledgers enable that really drive the potential value. These are the potential game changers.
Okay, let's hit them. Number one.
The shared system of record. This is fundamental. Instead of everyone keeping their own separate books, you have one shared ledger. A single source of truth, ideally.
So better information, everyone's on the same page, easier audits.
Exactly. Less need for that painful reconciliation between different systems, which
Yeah.
costs a fortune and takes ages.
But getting everyone onto one system sounds tough. And what about privacy?
Big challenges. Integrating with legacy systems is a huge task. You might end up with shadow records, the old book and the new DLT book, and like you said, legal
Sure.
uncertainty about which one counts. And yeah, putting shared data on a ledger raises major privacy questions, especially with rules like GDPR.
Okay, number two differentiator.
Flexible custodial arrangements, basically more choice in how you hold the asset or who holds it for you. It's about controlling the private keys.
So you could hold them yourself, self-custody.
Yeah, or have shared control, or use a hosted service, or full traditional custody. The report lists 4 types: full, collaborative shared, hosted embedded, and self-non-custodial. More user control, potentially.
But more risk too, right? If you lose your keys.
Exactly. That's a huge risk highlighted in the report. Lose the keys, potentially lose the asset forever. So secure key management and recovery options are absolutely critical. Custodian hacks are a risk too, of course.
Got it. Third one.
Asset fractionalization. This is a big one for accessibility, especially for things that are usually expensive or hard to split up, like, say, a building or a private equity fund.
So you can chop them into tiny pieces.
Right. Tokenization makes it easier to create and manage micro-units of ownership. This lowers the barrier to entry for investors, makes illiquid assets potentially more accessible.
Bringing things previously only for the big players to a wider audience.
That's the promise, though the report does note challenges, like making sure that fractional ownership is legally tight, especially for off-chain assets, and dealing with any issuer rules.
Okay, next up. Composability. Sounds techy.
It just means you can easily combine and reuse tokenized assets. Think of them like digital Lego bricks.
Ah, okay. Snap them together in different ways.
Yeah. Use an asset as collateral over here, then maybe include it in a structured product over there. It promotes multi-asset mobility, could boost liquidity, enable new kinds of financial products.
Powerful idea. Any downsides?
The report warns about limitless composability. If you can combine anything without clear rules, you could create super complex, risky derivatives, echoes of past crises maybe.
Mm-hmm.
And moving assets between different blockchains smoothly, that interoperability is still a challenge.
Right. And the fifth and final differentiator.
Programmability. Embedding logic right into the asset token or its smart contract.
Making the asset itself smart.
Kind of. So smart contracts can automate things, transfers, compliance checks, paying dividends, handling corporate actions. Big potential for efficiency gains, cutting costs by automating manual stuff.
But there's a paradox here, too.
Yeah, the paradox of programmability. Code is efficient, but it can be rigid. Hard to change quickly if market conditions suddenly shift or rules change unexpectedly. And if you still need lots of manual off-chain steps, you lose a lot of the automation benefits.
Fascinating. So huge potential benefits, efficiency, access, control, but clearly matched with real complexities and risks. Okay, let's pivot. Where is this actually being used right now, according to the report?
They map out 3 main areas: asset issuance, securities financing, and asset management.
And are some assets just better suited for this right now, more tokenization ready?
Yeah, the report lists traits like, is it regulatory readiness? Is the current process really manual and inefficient? Can the asset be reused, like collateral? Is there demand from institutions? Is it physically hard to handle, like gold? Does it trade in messy OTC markets? Is it hard to divide? How mature is the needed tech? Those kinds of things.
And different regions focus on different aspects.
Seems so. Advanced economies are often looking for efficiency gains in existing markets. Emerging markets sometimes see it as a chance to leapfrog, build new, efficient infrastructure where maybe less existed before, improving access.
Let's get specific. Asset issuance. Public equities first. That's a $115 trillion market globally. Huge.
It is huge. But interestingly, the report notes that the market cap for tokenized public stocks was tiny, around $16 million as of early 2025.
Why so small?
Well, in markets that are already pretty efficient, like major stock exchanges in developed countries, just tokenizing existing public shares doesn't immediately solve the biggest pain points compared to, say, private markets or bonds.
So the insight is tokenization targets the friction, not just digitizing for its own sake.
Exactly. For equities, the potential benefits highlighted are things like embedding IPO rules for better info symmetry or automating corporate actions. And the numbers there are pretty stark. Corporate actions cost each big player in the U.S. $325 million a year across millions of events. Automating that saves real money.
And maybe easier access for foreign investors.
Yeah, mitigating some of the costs and compliance hurdles, but again, it needs to show clear value over just using the existing rails.
Okay, what about fixed income? Bonds. Even bigger market, $140.7 trillion.
Now, this is where there's a lot of action. The report mentions an OM5 survey where 65% of financial institutions thought bonds would be the asset class tokenized most.
And governments are involved.
Definitely. The UK piloting digital gilts, U.S. regulators accepting tokenized treasuries as collateral, the U.S. Treasury itself acknowledging benefits, and Hong Kong is actually making tokenized bond issuance standard practice. They're prepping their third one.
So it's moving beyond just experiments.
In some places, yes. The European Investment Bank has been issuing bonds on-chain since 2021. Figures in the report show more and more issuers globally trying this. We've seen Sajin and Nomura issue compliant tokenized corporate bonds, and SDX in Switzerland, they've cleared over 1 billion Swiss francs in digital assets, partly thanks to atomic settlement using tokenized central bank money in a pilot. That's a big deal for efficiency.
The gains seem really concrete here.
They do. For bonds, the report points to better info symmetry by embedding data. Major operational efficiencies, like lower underwriting fees reported around 0.22%, tighter bid-ask spreads down 5.3%, potentially automating thousands of tasks, saving hundreds of hours, cutting book closing time by more than half.
Plus the accessibility angle again, fractionalizing bonds with high minimums.
Correct. The potential scale of efficiency improvements in the bond market is a massive driver.
Let's look at alternative assets. Private equity, $5.3 trillion market, maybe $7 trillion soon, and the report guesses 10% could be tokenized by 2030.
PE is a classic example of an inefficient market. Limited info, complex structures, lots of intermediaries. That makes it a prime target. 73% of European fund managers apparently think PE will be the first big asset class to get tokenized because the upside in liquidity, transparency, and access seems so obvious.
So again, targeting the friction points.
Exactly. Benefits are better info sharing, smoother operations, and fractional investments making it accessible. That ADDX example is pretty cool, bringing minimums down from over 100K to 10K. RM Equity Partners tokenized a $1 billion fund.
Though the report adds a caveat.
Yeah, a good reality check. Platforms like Equities already offer fractional access to private company stock with low minimums, like $5K without DLT. So fractionalization isn't exclusive to tokenization, but tokenization can turbocharge it, especially combined with programmability.
What about private debt or credit? Over $3 trillion there.
Another area where industry leaders expect routine tokenized trading soon. On-chain loans are happening, though often it's crypto folks lending to each other or targeting high net worth individuals with high yields, usually using crypto as collateral.
Similar benefits to PE.
Pretty much. Better real-time data, smart contracts, cutting back office costs, easier fund access. The report mentions KKR working with Securities to tokenize part of a $4 billion fund on Avalanche, lowering minimums for accredited investors. And lending protocols like Maple and Goldfinch have facilitated over $13 billion in loans. Activity is definitely growing.
Real estate. That's the giant. Almost $380 trillion globally, and maybe $420 billion already on chain.
Yeah, the potential is huge. Benefits include streamlining ownership records. They mentioned an Indian district putting 700,000 land records on Avalanche. Imagine the transparency gain and making transactions easier, fewer middlemen.
But real estate seems tricky. What are the hurdles?
Big ones. Local regulations around deeds and ownership are complex and vary hugely. Integrating with existing property registries is tough. Design choices can impact local economies. And let's be honest, REITs already offer a way to get fractional exposure to real estate.
Okay, commodities. Gold, $5 trillion physical market.
Tokenizing gold has really caught on. Makes it easier to access and use. Paxos, Tether, WisdomTree, even HSBC offer gold-backed tokens now. Benefits are accessibility by tiny fractions. User-friendliness, hold it in an app, choose your custody. And using it as collateral without physically moving bars around. That multi-asset mobility again.
What's stopping it from being even bigger?
Well, linking the physical vaults to the digital tokens is complex. You're relying heavily on the custodian and auditor, creating concentration risk. Not all tokens are easily redeemable for physical gold, and prices can sometimes differ from traditional markets because these tokens trade 24/7. Interestingly, just two tokens, PXG and XAUT, dominate like 99% of the tokenized commodity market right now.
Carbon credits next. Growing fast, projected $50 billion by 2050.
Tokenization seems like a natural fit here. A carbon credit is already a defined unit, 1 metric ton of CO2 equivalent. Tokenizing can boost transparency and traceability massively, helping fight double counting and greenwashing. Smart contracts can automate the transfer and retirement, and it opens the market to smaller players. Air Carbon Exchange is doing this, and there was a Standard Chartered pilot using tokenized deposits to settle credits.
But the quality of the credit itself is still key, right? Tokenization doesn't fix a bad credit.
Exactly. Tokenization improves the process around the credit. Groups like ICVCM are working on ensuring the underlying credits meet high standards. That's a separate but crucial issue.
Okay, shifting gears to securities financing. Collateral market over $25 trillion. Tokenization could unlock $100 billion a year here.
That's the potential efficiency gain from improving collateral mobility, making it faster and easier to move assets pledged as collateral between different parties, different custodians, especially across borders. Platforms like JP Morgan's TCN, HQLX, and Canton are tackling this because moving collateral today is often slow and complex.
And repos repurchase agreements are a big part of this picture.
Huge. $15 trillion outstanding globally, $3 to $4 trillion traded daily. But it's often manual, fragmented, prone to delays and errors. The report sees intraday repos, super short-term loans, as a prime area for tokenization.
So benefits for collateral and repos are
Better information, real-time view of complex ownership, like for money market funds used as collateral. Operational efficiency tracking transfers instantly, automating servicing. And that multi-asset mobility using different types of assets more easily as collateral. Canton's pilot with gold-backed tokens, SDX, allowing crypto assets. These are examples.
last big use case area, asset management, focusing on funds.
The report makes a distinction. On-chain funds tokenize conventional assets or the fund shares themselves. Off-chain funds, like crypto ETF, give exposure but aren't tokenized products.
While on-chain funds are aiming for broader access, lower costs, we've seen huge growth in tokenized treasuries on-chain, right? $104 million to $5 billion since 2023.
That jump is massive. It shows real traction. Examples like Franklin Templeton's Benji Fund or Ondo Finance, bringing treasuries onto public ledgers. Franklin Templeton's FOBXX was actually the first U.S. mutual fund using a public blockchain for its shares. Fidelity and Fasanara have launched tokenized money market funds too.
So traditional players are seriously experimenting here.
They really are. The insight is they're putting core products onto these new rails, looking for efficiencies, especially around using these assets as collateral.
But does the report say these funds are actually cheaper or perform better yet?
It's pretty cautious on that. It says there's limited evidence so far that they offer significantly lower admin fees or better returns than the traditional versions. The value might be more in the underlying infrastructure improvements and future potential.
And off-chain funds like crypto ETFs?
Still important because they bridge the old and new worlds. Spot crypto ETFs hit $136 billion in assets globally by late 2024. That shows massive demand from traditional finance for exposure to these assets, even if not holding tokens directly. And Franklin Templeton filing for a Solana ETF shows interest broadening beyond just Bitcoin and Ether.
Okay, that's a really comprehensive tour of where tokenization is making inroads. But, as we've hinted, it's not all smooth sailing. What are the big barriers to adoption the report digs into?
Yeah, this is crucial. The report makes it clear that success really depends on overcoming some significant hurdles.
First one, clashes with traditional financial infrastructure.
This is a major headache. How do you get these new tokenized systems to talk to the old legacy systems everyone still uses? Reconciling the on-chain record with the traditional books, that shadow records problem needs solving legally and operationally.
So, maybe a gradual approach. Using existing networks somehow.
Exactly. The report mentions a pilot using SWIFT, the existing messaging network, basically acting as a bridge. Chainlink, SWIFT, and UBS tested linking a private ledger to public networks via SWIFT for fund transactions, trying to smooth the transition for that huge mutual fund market.
What about the lack of global standards? Sounds like a big problem.
The report calls it a major stymie. There's just not enough agreement on technical standards, operational processes, industry collaboration. Get this, in 2023, Nearly three-quarters of DLT projects had fewer than 6 participants. That's massive fragmentation.
So everyone's building their own little thing.
Kind of seems that way. We need alignment on things like, what are the standard token formats? How does the cash settlement work? How do assets move between different chains safely? What about basic reference data? It'll take time. The HKMA in Hong Kong has a working group on this.
The report mentions specific token standards like ERC-20, ERC-1400, ERC-3643.
Yeah, it does. ERC-20 is everywhere for simple tokens, but it's not built for regulated assets. It lacks compliance features. So standards like ERC-1400 for securities, and especially ERC-3643, which is called TRX, are important. TRX embeds identity, KYC, AML rules right into the token. That allows compliant transfers. The point is these standards need to mature and align with regulations like MiCAR in Europe.
And related to standards is cross-chain interoperability, moving assets between, potentially dozens of different ledgers.
At least 72 different ledgers being used by financial services as of early 2025, according to the report. So yeah, making sure assets aren't trapped on one chain is critical for liquidity and preventing silos.
Is tech emerging to solve this?
It is. Things like Chainlink's CCIP, which acts like a universal translator between chains, or Layer Zero's OFT standard, which aims to let tokens exist natively on multiple chains without risky wrapping. It's a complex area, but vital.
Okay, barrier number 4, secondary markets. If you tokenize something, you need somewhere liquid to trade it.
Absolutely critical. And the report points out this is a real weakness right now. Liquidity is often very low for tokenized assets. That stat is stark. Nearly half of the $15 billion in tokenized bonds issued had turnover of less than $1 million. That's practically untradeable.
Why so illiquid?
Several reasons. Not enough incentive for market makers to provide liquidity, especially in OTC markets. Minimum investments might still be too high for many, even with fractionalization. Regulatory hurdles, especially cross-border, often only institutions can access these markets currently. Listing fees can discourage issuers from putting tokens on multiple exchanges, though UBS did dual list, which is interesting. And just fragmenting things with lots of separate little cash systems doesn't help either.
So we need incentives for market makers, maybe expand regulatory sandboxes.
Some of the report suggests, yeah, help kickstart that liquidity.
Final barrier, privacy and compliance. This seems like a fundamental tension. How do you do KYC/ML on transparent ledgers?
It's a huge challenge. Different identity checks everywhere add cost and friction. The report says standardized KYC could cut fund onboarding costs by maybe 90%. On-chain identities could help, but raise massive privacy flags. And financial regulators, following FATF rules, require tracking who's doing transactions, which clashes with the idea of anonymity. So purely anonymous transactions just aren't suitable for regulated finance.
Are there tech solutions being worked on?
Yes. PPT's privacy-enhancing technologies, like zero-knowledge proofs. These let you prove something is true, like you're allowed to hold this asset, without revealing the underlying private data. BIS is looking at this. And token standards like ERC-3643 enforce rules, while others like ERC-5564 offer stealth addresses for some privacy.
The report mentioned allow lists versus deny lists, too.
Right. Allow list. Only pre-approved people can hold the token. More secure, maybe less open. Deny list. Anyone can hold it unless specifically blocked. More open but needs constant monitoring, reactive. Big challenges remain, like storing personal data on-chain, clashing with GDPR's right to be forgotten, the need for quantum-proof privacy tech eventually, and making sure systems comply with the FATF travel rule about passing sender-receiver info along. It's a really tricky balancing act.
That's a serious list of challenges, but assuming these can be tackled, how does the report see tokenization actually changing the impacts on the financial world?
The big message is, change is coming, but it's about evolving roles, not just eliminating everyone. Existing players provide trust, safety, soundness that's essential. The HKMA's digital currency pilot showed intermediaries were vital for liquidity and user trust.
So disintermediation isn't the main story.
Not necessarily wholesale disintermediation. While some experiments try it, the report focuses more on how incumbents' jobs will change. And regulatory sandboxes like in the UK, EU, and Singapore are helping figure out these new structures safely.
Okay, so how do roles evolve? What about the buy-side and sell-side firms?
They'll need to handle things like reusable digital identities for clients, advise on tokenized portfolios, automate orders via smart contracts, settle trades on-chain, manage digital wallets, maybe even support self-custody, like Robinhood is exploring.
And issuers, companies raising capital.
They could use tokenization for on-chain capital raising, automate corporate actions like voting or dividends directly through the tokens code, potentially reducing fees for things like underwriting or legal work.
Exchanges, CCPs, CSDs. The core market infrastructure.
Exchanges will need to support tokenized listings, maybe integrate automated compliance rules, like Deutsche Börse is doing. CCPs might focus more on governance, managing tokenized collateral, handling cross-chain risks. CSDs could issue assets using digital IDs, manage on-chain settlement, validate ledgers, and crucially, automate asset servicing. That stat, about 78% of FIs still doing corporate actions, manually highlights the potential here. They provide compliance, support wallets, interoperability. BNY Mellon helping BlackRock with on-chain data for their fund is a prime example of a custodian adapting.
And transfer agents, the ones keeping shareholder lists.
They're often highly manual now. Tokenization offers huge efficiency gains via digital IDs for KYC. Remember that $2,600 average onboarding cost? TAs could use ledgers to automate cap tables, handle direct on-chain transfers, programmatically manage corporate actions. They could become digital transfer agents using smart contracts like WisdomTree and Securities are exploring.
Beyond incumbents adapting, the report expects entirely new market roles.
Definitely. New specialist intermediaries and digital native service providers. Think new structures like token issuers developers who actually build the tokenized assets and platforms, specialized digital asset custodians focused only on secure key storage, and dedicated digital asset exchanges.
And new types of service providers, too.
Yeah, like on-chain identity providers to streamline verification, interoperability providers building the bridges between systems, node operators running the actual ledger infrastructure, specialist key management firms meeting high compliance standards like BitGo or Medico, and smart contract auditors checking the code is safe. These will likely need licenses, and big firms might buy or build these services themselves.
And all this change could enable new products.
That's the potential unlocked by composability and programmability. The report mentions things like flash loans, instant uncollateralized loans that are inherently risk-free because they happen within one transaction block, using crypto as collateral more easily in traditional finance, or smart funding, automatically managing assets to meet payment needs, like converting ETH to stablecoins just in time.
It really paints a picture of potentially significant change. The report also stresses key design choices for the future: infrastructure, settlement assets, even operating hours.
Crucial decisions that will shape how this evolves. Let's start with infrastructure. Permissioned versus permissionless ledgers.
Financial institutions historically preferred permissioned, right? More control.
Yes, private ledgers or public ones with restricted access. They offer control, oversight, easier compliance, clear dispute resolution. Think JP Morgan's Connexes processing trillions or Citi's CIDAP. The challenge is getting enough people onto one private network to get real benefits network effects. It can shut out smaller players.
But now the report says FIs are increasingly exploring permissionless public ledgers.
Yes, quite significantly. They're actively using at least 30 public ledgers now. One
Right.
shift, lower costs sometimes, access to huge pools of developers on platforms like Ethereum or Solana, massive network effects because anyone can potentially join, inherent transparency and improving performance on these public chains.
So big names are building on public chains.
They are. Franklin Templeton's fund runs on Avalanche and Polygon. BlackRock's BUIDL is across Ethereum and several others. Deutsche Bank is even planning a sort of private layer on top of public Ethereum using ZK proofs for compliance. The insight is, institutions want the benefits of public networks but need ways to manage compliance and risk, leading to these hybrid or layered approaches.
Public chains still have challenges, though.
Oh, absolutely. Potential stability risks if transparency amplifies problems during stress. Congestion and fees can spike. That privacy versus transparency tension. Lack of built-in identity needing external solutions. And just ensuring clear responsibility, business continuity, reversal mechanisms on these open systems.
Okay, and another huge design choice: the settlement asset. What do we use for the cash leg on-chain?
This is maybe the critical bottleneck. 79% of people in their survey said regulatory clarity here is vital. Without a trusted, risk-free way to settle payments on-chain, ideally central bank money, according to global principles, it's hard to scale DVP for tokenized securities safely.
That's the preference.
Well, 59% in one survey preferred a wholesale CBDC for settling DLT-based debt. The ECB is working on ways to get central bank money onto DLT. Other options are stablecoins, those RBDCs like Finality's building, deposit tokens. Broadridge integrating with Finality for real-time DVP is a key example. Basically, trustworthy on-chain cash unlocks a lot.
And finally, operating hours. Does tokenization mean everything runs 24/7?
The report says it's a choice, not automatic. Many markets need downtime for maintenance, clearing, settling. Even the NYSE, running 22 hours, needs a break. It's complex tech, business processes, time zones, matching trades, ensuring liquidity is there when needed. DeFi is 2047, but regulated markets have different constraints.
Got it. So wrapping up, what are the final big considerations the report emphasizes for actually deploying this stuff safely?
Two main buckets: cybersecurity and financial stability, and underlying both, regulation.
Okay, cybersecurity first.
Absolutely critical. And interestingly, the report notes many breaches are still classic cyber threats, phishing, malware, insiders, not just people losing keys. That Bybit hack in 2025, $1.5 billion lost despite sophisticated security, shows operational links and third parties are weak points. We need harmonized security standards, robust threat planning, super secure key management using things like HSMs or MPC.
And the quantum computing threat is real.
It's a serious long-term concern. Quantum computers could eventually break today's encryption. The harvest now, decrypt later attack is the worry steal encrypted data now, crack it later. So we need to develop quantum-resistant crypto and privacy tech. Secure design choices now can help mitigate this future risk.
What about financial stability? Is tokenization a risk to the whole system?
Right now, the scale is too small, so risk is minimal. But as it grows, the Financial Stability Board warns about potential issues: mismatches between asset liquidity and funding, risks from complex leverage and reuse of collateral, rehypothecation, hidden risks from all that composability, concentration if a few platforms dominate, and operational glitches causing wider problems.
How do we prevent that?
The report mentions FSB strategies. Put some limits on limitless composability, have strong governance for these multi-party systems, embed rigorous smart contract audits, maybe favor natively issued tokens to reduce mismatches, and actively manage concentration risk, promote competition, distribute power.
And underpinning everything, regulatory development.
This has been the biggest break, that lack of clarity. But the report shows real momentum now globally. Luxembourg's laws, Liechtenstein's Comprehensive Act, the EU's MiCA and pilot regime. In the U.S., signs of a more pro-digital stance, regulators accepting tokenized assets, Hong Kong pushing ahead with bonds, the U.K. actively supporting fund tokenization. This growing clarity is what the industry's been waiting for.
Wow. Okay, we have covered a lot of ground from that WF report. We started with the basics: tokens, ledgers, models, attributes. We explored the why, the value proposition around transparency, control, efficiency, access, mobility.
Yeah, and we saw the real examples in bonds, private markets, commodities, carbon credits, showing actual cost and time savings potential. But importantly, we also hit what's stopping us, the barriers: integration, standards, interoperability, liquidity, privacy, compliance. Big hurdles.
And we looked at how this changes things: evolving roles for incumbents, new players emerging, critical design choices about infrastructure, settlement, operating hours. It's definitely not simple. It needs careful navigation of risks and ongoing regulatory progress.
It's a complex transition happening step by step, not all at once.
Hopefully this deep dive has really helped you get your head around this complex but important topic, given you some concrete examples from the report, and left you feeling genuinely well-informed about where the future of value exchange might be heading.
It's definitely a future that's taking shape right now.
So here's a final thought for you to chew on. As financial markets keep evolving, maybe towards these more programmable, always-on systems, what role could tokenized assets play in your own financial life? Or even just in the wider economy you use every day?
Something to think about, for sure.
Thanks for diving deep with us today.